us here to talk on financial management today. Financial management, to understand these two different terms, one is finance and another one is management. We already learned management. It is an art of getting things done by others for effective utilization of available resources like men, money, material, machine and methods. So here we are not here to discuss management but finance. So next slide, it's all about business finance. See, there are two words. One is business and another one is finance. Business finance means finance required for the business activity. The term business finance of two words. One is business and another one is finance. Now we need to understand what is business. Business means buying and selling of goods and services. It is nothing but the trade. We need to understand the trade. There are three types of trade. One is import trade, next export trade and interport trade. Now what is import trade is all about? Import trade means what? For example, take India. India is home country for us. If we purchase the goods from some other country like Japan, like America, China, Russia, Nepal, there are so many countries we procure or purchase to home country. It is nothing but your import trade. See, maximum if we depends on imports rather than the export, it is a negative indication to our nation. Because if we import goods from other country, what happens? No doubt the goods will flow from other country to home country, but we need to pay our Indian rupees to their countries. So cash will outflows. So if cash decreases from our country, it is indication towards the decrease in the standard of living, decrease in the per capita income, decrease in the GDP. So the export trade is very important, my friends. What is export trade? Export trade means what? We sell our goods and services to other countries. Okay, making the goods and services from India, in India and sending to other countries. What happens if we do this? We'll take the cash from other country to our home country. So it is very important in case of balance of payment and balance of trade economics to develop the standard of living of our Indian people and maximization of GDP, gross domestic product, and will compete with other countries to sustain a longer period of time in the world at the large. Next, coming to interport trade. So what is interport trade? For example, India is our country. We are living in India. We are buying the raw material from XYZ country to India and getting finished product in India and again sending to some same country or some other country. It is known as interport trade. For example, America, what America is doing? America is buying the wheat jawar from India and getting finished product in their home country, America, that is pizza. So America is selling the same pizza to us and we are consuming the pizza. Our cash is going out. What America is doing? America is procuring our ingredients, our raw material at the cost of, say, an example, 10 rupees. So it is going to America, America getting the finished product like example pizza. Again, same pizza is coming to us we are buying at the cost of 100 rupees, 120, 150. See, when it is going to other country, we are getting 10 rupees and again we are consuming the same product coming from America at the cost of 100. See the difference, 100 minus 10, 90 rupees. It is going from India to America. So this is the interport trade, what American is applying. So India must apply this interport trade. Purchase this one raw material from other country and finish the goods in your home country and supply to entire globe. This is the right time and opportunity for India to trade with entire nation. Friends, here the meaning of business given in the slide. Business means state of being busy. It means every person engaged in one or other activities to earn income for his livelihood. What does it mean? Every person engaged in one or another activity or state of being busy. Friends, state of being busy doesn't mean that you're busy in chatting with the people, you're busy with gossiping with the people, you're busy in your other stuffs. It is not at all called state of being busy. Here in business, state of being busy means what? You're busy as a CEO, you're busy as a COO, you're busy as a managing director, you're busy as an assistant managing director, you're busy as a zonal manager, you're busy as a area manager, you're busy as a financial manager, you're busy as a marketing manager, you're busy as a HR manager, you're busy as a production manager, you're busy as a human research and development in charge, you're busy as a supervisor, you're busy as a team leader, you're busy as a subordinate, you're busy as an investor, you're busy as a planner, organizer, staff, and so on. That is nothing but the state of being busy. It doesn't mean that you're killing the time. Busy means investment of time. When you are investing your time, you are expecting returns. That is called your state of being busy. Again, it is clearly said, business means state of being busy. It means every person engaged in one or other activities to earn income. Investment, return, income. If you are working as an employee, you are expecting salary, commission, bonus, TA, DA, and other allowances. If you as an entrepreneur running your business, you are expecting the profit annually. That is what the profit maximization and wealth maximization theory says. This is all about the business, my friend. The next slide is all about the word finance or finance. You can use both finance and finance. American English and British English. Right. Here, the word finance is derived from the Latin word finis, which means finance or money. Finance is defined as a provision of money as and when required. Why we use the word finance? Because the word finance is derived from one of the Latin word called finis. Finis means an amount or money, maybe Indian rupee, maybe Sri Lankan rupee, maybe Pakistani rupee, maybe pound sterling, maybe US dollar, maybe euro, and there are so many currencies across the world. So this is what the finance we use, Indian or rupee in case of India. See, the next, finance is defined as the provision of money as and when required. See, you have to procure the finance whenever you are in need. Unnecessary, you cannot go to public and raise fund. It means you are incurring a cost bearing. So unnecessary, please, you cannot go to the procurement of fund and save the fund in your treasury. It is not good indication to your company. So whatever fund you require, procure from number of sources and distribute the fund. Use in a proper way so that it gives best return to you. The next slide is all about the definition of finance. See what R.C. Osborne said. According to the R.C. Osborne, the finance function is the process of acquiring and utilizing the fund by a business. I already told you, acquiring the fund from various sources and properly utilization of funds. Planning, distribution and control is very important, being a financial manager in the organization. So next you can understand the meaning of financial management. Financial management is a part of management. There is a top level management, middle level management and lower level management. Your financial management come under middle level management like financial management, marketing management, human resource management, production management, other management and research and development team. So here the one of the management called financial management, it comes under middle level management and it is directly connected with the top level management because it is financial matter, right? So financial management is a part of management activity which is concerned with the planning and controlling of firm's financial resources. So very important, the first and primary functions of financial manager is to plan for finance, procurement of fund. So there are four important points here in case of financial management or being a financial manager. It's all about financial planning, collection of funds, use, distribution of funds, and financial decision. So what is this financial planning is all about? Financial planning means how much finance you require for the fixed assets, how much fund you require for the current assets, fixed asset and current asset. See my friends, you need to understand the fixed assets. There are two types of fixed assets. One is tangible fixed assets, another one is an intangible fixed asset. Tangible fixed asset or an intangible fixed assets are those assets which cannot be converted into cash within 1 year of time. It is longer period of time. Tangible assets are those assets which we can see, which we can feel, which we can realize, which we can touch. Such assets are called as tangible fixed asset, like for example land, building, plant, machinery, furniture, fixture, motor van. So these are the tangible fixed assets. Whereas you have an intangible fixed assets also. For example, goodwill, the brand image of a company, patent, you have copyrights, you have likewise many other intangible assets. So proper planning must be done by the financial manager. In case of financial planning, how much fund is required for the fixed assets and how much fund is required for the current asset. So current assets are those assets which can be converted into cash within a year or less than 12 months of time. Such assets are called as current asset. Maybe current asset, maybe non-quick asset. Current asset, non-quick asset. Current assets are those assets which can be converted into cash within 1 year of time. It is also known as non-quick asset. Quick assets are those assets which can be converted into cash within 3 months of time. Less than 90 days you can convert. Being a financial manager, you need to maintain liquid asset in the organization, cash in hand and cash at bank, and marketable security also to meet the day-to-day obligation of the organization, like payment of salary to the employee, payment of wages to the labor, payment of electricity bill, payment of water bill, payment of exercise, payment of custom, payment of duty, okay, in combination, GST we have to pay. So, being a financial manager, we need to maintain cash in hand, cash at bank and marketable security. It's all about assets, fixed assets, current assets. Fixed assets are those assets which can be converted into cash, which cannot be converted into cash within 1 year of time, whereas current asset can be converted within a year or less than 12 months of time, and quick asset within 90 days to meet the day-to-day obligation in the organization. Here you need to decide how much total fund you require. Once you collection is very important. Being a financial manager, you cannot go to equity and raise the fund, or preference and raise the fund, or debenture and raise the fund, or return earning and utilize the return earning, flowing back of profit, undistributed dividend. No, my friends, you have to plan. Proper proportion must be decided, whether equity this much portion, preference this much portion, debenture this much portion, and we have reserves and surplus already. So how much portion of reserves and surplus will be utilized and how much portion will be distributed among the shareholders. Shareholders also very important, my friends, because maximization of wealth is one of the important objectives of financial manager. There are two objectives. One is profit maximization and another one is wealth maximization. Profit maximization objective has got certain limitations, whereas even your wealth maximization has got some limitations. So both this one objective leads to profit maximization. More concentration is on wealth maximization because it is directly related to the shareholders. Sales minus variable cost, contribution minus fixed cost, EBIT, less interest, EBT, less tax, EAT, less preference dividend, equity dividend, divided by number of equity share, earning per share. Being a financial manager, you need to concentrate on earning per share and market price of the equity shareholders or preference shareholders. So proportion must be decided here in the collection of funds. So you being an expert in finance as a financial manager, call your team members, decide the proportion and procure the fund. So after planning the procurement of finance by various sources of finance based on the proportion, and next the distribution of funds. How much portion of the collected fund will be distributed among the fixed, this one asset, and how much of portion will be distributed in current asset. So balance must be maintained, and some of the portion must be kept as a reserves. This one reserves. Uncertainty may arise any point of time in the business. So you need to have some reserves and surplus to meet the obligation, the future obligation, uncertainties, okay, contingencies. Right, next one is user distribution of fund is done. The next financial control. After all, after planning and collection of fund and distribution of fund, you have to control entire planning and distribution of fund and fixed asset, current asset, and day-to-day obligation of the organization by planning, organizing, staffing, directing, controlling, coordinating, leading, innovating, reporting, budgeting, and communication. So friends, this is all about the finance introduction. Please wait for my upcoming video on objectives of financial management and other jargons of financial management. Please stay home, stay safe. Thank you.